in Google, the most popular mutual fund search string is best performing mutual fund. So essentially what happens is most people look at the performance of instruments in the past and invest in those instruments, right? So typically you'll see any mutual fund which has done really well. In the subsequent year, the AUM actually swells dramatically.
So performance and AUM is lag.
Yes.
There's a lag effect, obviously.
There's a lag effect. And when I'm chasing previous performance, I am very often disappointed because the same performance does not replicate. In fact, over time, when things mean revert or go back to the average, the fund that has done well in the past is quite likely not to do well in the near future, right? And that is actually one big reason of underperformance. The second big reason of wealth destruction is, party conversations. Because in a party, when I'm meeting you over a drink, I'll only tell you about those investments where I did really well. And you will never hear from me what I lost money in. After typically some of those conversations is when people open trading accounts, F&O accounts, etc. and start doing investments. So in a sense, chasing past performance and borrowed conviction are two big reasons why people lose money.
Folks, welcome to PaisaVaisa. I'm your host Anupam Gupta, B50 on Twitter. I am thrilled to welcome back, this time in the studio, Sandeep Jethwani, co-founder Dezerv.in. We are talking about wealth management and much more. So we had Sandeep online on our show back in March 2022. It's great to have him in the studio. Sandeep, welcome to PaisaVaisa. Thank you so much for doing this for our listeners.
It's so good to do this in person.
Face to face, no?
Yeah, and with the book around and you in person, it's exciting.
And with Dezerv having walked so much of a distance and come so far in these last 2 years that we've done this, and like we were talking before the show started, you have your own content also now. So that it's good to see Dezerv growing, changing, transforming in just 2 years, which is like, you think it's just 2 years, but you've done a lot in that. So let's start for our audience who doesn't know about Dezerv, hearing it for the first time. Let's start from there. So what is Dezerv?
Anupam, we truly believe that India is going to be a wealth creation country over the next few years. And all of these wealth creators who are working so hard in building this wealth need help in compounding and growing that wealth. We want to be the investment manager of choice for wealth creators in India. And that's essentially what we do. We create investment solutions that we research very deeply. We own the performance of what we deliver. And that's essentially what Dezerv is all about.
Yeah. And just to get the hygiene out of the way in terms of regulations, in terms of licenses, of course, folks, the website is dezerv.in. All the details are out there. But just for our audience's knowledge, who's your regulator, what licenses do you have, etc.?
So our regulator is SEBI, and the main license we operate under is a portfolio manager's license, which enables us to manage money both on what is called discretionary and non-discretionary vehicles. And I'll explain these terms. Discretionary is where the client has given us the mandate to manage money, and day-to-day transaction decisions are taken by us. And non-discretionary is where we make recommendation and the client presses the go or no-go button. Majority of the assets are in our discretionary platform. By the very nature of the license, there are certain minimum thresholds. The fact is that we can only charge fee transparently, which is something that the regulator looks at very closely. We can't have any ancillary income out of it, which is again embedded in the regulation. And there are reporting and auditing norms which are established very well for the portfolio manager industry. So that's the primary license we have. We also have an alternative investment fund license, which allows us to essentially create alternative assets as and when we believe that there is an opportunity. And finally, from the very early days, we've had a mutual fund distributor's license, which enables us to make individual recommendations on mutual funds. But I would say a largest part of our assets is in the portfolio management side or the alternative investment fund side.
What's been happening in the last 2 years? I mean, when we had met last, that episode was more about your background and how your team's background actually. Maybe we'll just start from there in a small way and then tell us what's been happening in the last 2 years. From the time that you guys started, what's been happening?
So, Anupam, a quick recap on our journey has been that the three of us co-founders have been in this industry for nearly 20 years now. The only business or the only job I've ever known is that of a wealth manager. I graduated from IIM Bangalore and joined Kotak in the wealth management business in the very early days. and most people won't remember it, but this was a time when Kotak was just becoming a bank. And for some of our younger listeners, Kotak has always been a bank, but that was not the case. It was a brokerage and NBFC and later became a bank. So I was a part of the team that built out wealth management there. And 2008 was fortunate to be a part of the founding team at this company called IFL Wealth, now called 361. Where I've been on the business side. I led the portfolio management business under IFL One. By 2020 or 2021, I was feeling that the new age wealth creator is fundamentally different and needs a whole host of solutions in the current market context. Majority of clients are struggling with this one reality that just in the last few years, the number of mutual funds has exploded. There are, at last count, 1,800 schemes, plans, options to choose out of. There are close to 7,000 stocks that you can invest in. There are 20-odd thousand traded credits in India. How do you create portfolios out of that? And that was essentially the problem that we set out to solve. Our fundamental belief is technology plays a massive role in solving new age problems. And that's essentially where we started Dezerv.
So sorry, you were saying?
No, I was just saying that in the last 2 years, getting the licenses and scaling from there has been a big part, and getting to know our clients better and over time increasing the assets under management has been what has kept us busy.
Yeah. So I want to get into wealth management, the industry and stuff like that. But before that, I want to understand the concept of wealth in terms of quantity. I know because we recently had LGT. LGT is a fairly large. They do wealth management for family offices, and in Europe, I think they're one of the oldest out there.
Sure.
One of the comments that we got for that particular episode was ticket sizes. Like, how do I understand what we're talking about out here? So when you talk about wealth, in the wealth management industry, maybe let's start from there. That what is wealth? Is there a number to it? A minimum ticket size? We know that for PMS it's 50 lakhs. So that is a certain number out there. But anything else for our audience to understand what is this? What does a wealth creator look like? What are his requirements?
Who is this wealth creator?
Who is this? Yeah.
It's an interesting question. So let me start from the top. There are 24.5 crore households in India, right? The top 1% of them top 1.1% is about 27 lakh crore households.
27 lakh households, yeah.
27 lakh households who have more than $100,000 or 80 odd lakh of investable surplus. I would call that as the wealthy segment in India.
So any household who has a crore, roughly 82 crore,
about a crore or more of financial assets.
That's the threshold.
That's the threshold.
We're not including stuff like gold and real estate.
No.
Saying, okay, this is the disposable surplus, corpus, or whatever you want.
And invested in financial assets of any kind. It can be fixed deposits, equities, mutual funds, PF, etc. Right? So that's essentially a wealthy person in India, right? And remember, it's still a very small percentage of India, right? That means 99% of India does not fall in that category. It's just the top 1%.
And just to put it in perspective, this is stock number, not a flow number. As in, this is the corpus or this is the net disposable investable surplus that we have. Okay.
And if you look at the flow number and think of it as taxpayers, which is also debatable in India, it's people with more than 1 crore of income would be in the range of 2 odd lakh folks. So that number will be significantly lesser than this. But given that India is a savings country, this is about 27 lakh households who fall in the wealthy category.
What are the trends out here?
First of all, financialization is a massive trend, right? And I can't, underemphasize this particular or overemphasize this particular fact. The reality, what is happening is that for the very first time, the default is to invest in financial assets, right? Courtesy of various things that have happened, maybe cultural changes, maybe some bit of economic policy changes, etc., like GST. A lot of money which was earlier outside the sort of regulated ecosystem has now come here. And naturally, the first port of call for this money is deployment in financial assets. Today, if you think about it, and even within financial assets, the concept of managed assets is actually becoming much larger. Mutual fund AUM at last count is about 58 lakh crores. It is already 27 to 28% of the total deposit base. The mutual fund universe is growing, or the AUM base there is growing at about 18% year on year, while the deposit base is growing at about 11%. So the broad trend of financialization and increasingly moving that to managed assets is very real. Obviously, the flip side of this is some concerning behaviors in terms of how some of these monies are getting deployed, like futures and options. And we can talk in a bit about that. But broadly, those are the trends that we are seeing within this category.
Can you just break down the demographic out? And now that we have a number on the household, we've got a number of, we have a number on stock and flow, which is one, the people with that much of corpus, and two, the people who make that on an annual basis in terms of their salary or whatever it is. Who are these people and what are their profiles? What am I looking at out here? I mean, I know that there are only two that's possible. One is salaried and one is business. But within that,
let me talk about the big shifts which are happening. So the first is obviously there is a pool of retirees or people who are towards the end of their working life, in the late 50s, early 60s, who have a reasonable amount of savings and fall in this category by the virtue of the savings they've had, and also the retirals that they're likely to get. Within the salaried category, what is actually very interesting is the younger population, which suddenly is becoming very, very meaningful. So if you think about it, just the four tech startups which got listed, or tech companies which got listed, have about 30,000 crores of ESOP wealth that those four have created.
Hold that thought.
Yeah.
4 startups that recently listed have got an ESOP pool of 30,000 crores.
Yes.
Wow. Okay. I didn't know that number was that big. I mean, I had an inkling that it would be fairly large because startups, for startups, that is the primary source of remuneration for the employees. So who are the 4? I think Zomato,
PolicyBazaar and Paytm.
Oh, wow. Please go on.
Now, if you look at, or actually, let me give you another data point since we are talking about it. In the first half of 2021, announced buybacks were of ESOPs were in the range of around $1 billion.
Wow, so that's about 9,000 odd crores.
9,000 crores. I might be undershooting on that number. It might actually be slightly larger than that, right? So my guess is that over the next 4 to 5 years, anywhere between 2 to 4 lakh crores of wealth will get created by employee ownership in businesses.
Yeah, to break that down in simple terms, what you're saying is that is the money that's going to come to employees.
Yes.
Hit their bank account once they're able to sell their shares and cash their options, and and of course that'll be staggered, that'll be as per the companies. We don't know that, you don't know that,
correct,
but that's a rough number.
Exactly.
Huge. Go on, please.
So I think that is one big category. What is the tougher part to estimate is what self-employed professionals or business owners are going to get, right? We are seeing tremendous amount of OFS, or offer for sales, which is essentially where a promoter is taking his or her company public, and at that point they are selling some bit of equity. Later on they do some bit of on the market sale also, and that's just on the listed side. We see nearly 8 to 10 liquidity events being announced in India on a monthly basis.
Monthly?
Which is what we are hearing of. Wow. Now, let me explain why this is happening. Traditionally, what was happening was there was huge tax arbitrage available, in that if I wouldn't generate an invoice and I take money from you for my business in cash, therefore I wouldn't pay tax on it. Now, suddenly, all of that business, courtesy of GST, has to be converted to invoiced, and therefore I have to pay tax on it. Suddenly, a lot of small businesses are no longer making sense because the tax arbitrage, the tax saving has gone away, right? And therefore, these smaller businesses will find homes in a part of a larger business. And we are seeing that consolidation play out all over the country, right? I was recently talking to somebody, in an interior Maharashtra, and they sold their business. It was a small industrial business. And courtesy of, platforms like what the Ministry of Corporate Affairs, you can see the company's profitability data, right? So there was almost in the 2018-19, there was a sudden spike in profitability. And before meeting the client, you would typically do some research. So I asked the client what happened in that time. So he said everyone started demanding invoices, right? So then I had to do it. And then I realized my taxable income has gone up and I'm paying more tax. I would rather sell this business and get liquidity today, right? So that trend is a very real and big trend.
Sure.
So a lot of money will come in the hands of such self-employed or small business owners, right?
Yeah.
And I think that's going to be a second big category.
So you've got liquidity, you've got liquidity events, you've got ESOP pools, you've got businesses transforming. All of that is going to place. The numbers can be anything out of maybe from a few lakhs to a few crores in the hands of people who have no idea what to do with it.
So financial wealth by 2027, I think McKinsey, I recently did this analysis, will be about $2.6 trillion.
Just for India?
Just for India.
Okay. Now when you put these numbers in perspective, it's quite obvious that if you're working a day job at a startup or you're handling your business, that's what you do. Managing investments is not something that it would come naturally to you.
So let's say there is a concept of wealth creation and wealth management, right? Wealth creation should be anybody's full-time job, right? And wealth management should either be a part-time job or should be delegated to somebody.
You think so? You actually think so? Because you were talking about how people are dabbling into F&O. You think that they want to create wealth in F&O and they think that they can do. I'm saying this in a very joking way, but it's a serious.
But I'll tell you, actually, so some of these numbers are worrying. Okay, let me just. And I was just recently doing this analysis. This was a thought experiment. I'm not even sure there's any validated research around it. Okay, in FY22, there were close to 50 odd lakh registered F&O trading accounts. Okay. So that is the one number.
Fine.
Okay. I'll give you a second number which SEBI put out to say that the average trader in FY22 lost 1.1 lakhs.
Yeah.
Right?
That number is out in the public domain. SEBI has said it.
Yeah. So 1.1 lakh rupees was lost by 500 million individuals.
Yeah, okay.
And then you multiply those two numbers, it seems like there's 55,000 crores of wealth destruction that has happened in FY22.
All the best with that anyway you tried it, but please go on. Yeah.
Now, let's say equity markets compound at 14%. In 10 years' time, this is 2 lakh crores of opportunity cost. If today investors have lost 50,000 crores or 55,000 crores of capital, in 10 years' time, they've actually lost 2 lakh crores.
By doing all this trading and F&O and puts and calls and all that. Which
Absolutely.
They probably don't understand.
And, and this is even becoming even bigger, right? Yeah. We are recording this on June 4th at the end of what has been a very crazy day in the equity markets. But I still see a lot of people figuring out what do I do of the calls that I have. I have sold puts, etc. So this is a very real problem that's happening.
We'll probably need one more episode. Let's go back. Okay, yeah. You started with the premise that wealth creators need wealth managers.
Yes. Let me give you another interesting point, right? Last year, we launched this platform called Wealth Monitor. Now, what Wealth Monitor essentially does is it imports your existing mutual fund portfolio and does a review of it and benchmarks the funds against the respective indices of those funds and tells you whether you actually made more money than the index or lost more money than the index. 65% of portfolios, 2/3 of portfolios have actually underperformed the index.
I think they would be better off if they just bought an index fund.
Number one. Number two, this amount of underperformance on the 59,000 crores at last count that we have reviewed is about 3,000 crores. So just in the small base that Dezerv has analyzed, we are looking at 3,000 crores of missed gains, right? And the sad part is that full-time day jobs, people are working so hard to create wealth. Is their wealth working as hard as they are I think is a question that we need to ask
Okay,
ourselves.
so I'll let the wealth creators who are watching this to figure that out. One reason could be that these wealth creators, these people who have investable surplus, don't know where to go.
Yeah.
There's obviously a trust deficit somewhere that I think has been well known for quite some
Yeah.
time. Even when I wrote that book and I spoke to a lot of the people, that is there. So
Yes.
what happens? What is the process? Like, let's say that I am someone who's either sold my business, like you said, or I'm someone who's working in a startup. I sold out my options. I've got whatever, 10 lakhs, 20 lakhs, whatever that number is. Typically, what do these people do before they realize that I need good advice?
In Google, the most popular mutual fund search string is best performing mutual fund.
Okay.
So essentially what happens is most people look at the performance of instruments in the past and invest in those instruments, right? So typically you'll see any mutual fund which has done really well. In the subsequent year, the AUM actually swells dramatically, right?
So performance and AUM is lag.
Yes.
There's a lag effect, obviously.
There's a lag effect. And when I'm chasing previous performance, I am very often disappointed because the same performance does not replicate. In fact, over time, when things mean revert or go back to the average, the fund that has done well in the past is quite likely not to do well in the near future, right? And that is actually one big reason of underperformance. The second big reason of wealth destruction is, party conversations. Because in a party, when I'm meeting you over a drink, I'll only tell you about those investments where I did really well. And you will never hear from me what I lost money in. And after typically some of those conversations is when people open trading accounts, F&O accounts, etc. and start doing investments. So in a sense, chasing past performance and borrowed conviction are two big reasons why people lose money.
Yeah. So now, just before going into the break, Sandeep, what is the wealth management industry data like? You spoke about McKinsey's number of 2.67 trillion. We spoke about how you slice and dice the demographic. But any other number that really interests you, that shows you where we are going or what you're tracking?
So just today, if you look at the organized managed assets business, or people like the formally where some wealth manager or some sort is managing your money, that business is about 1.2 trillion dollars in India, right? And the professional wealth managers, the focused wealth managers, manage only about 12% of that. So about 120 odd billion is managed by wealth managers. The rest of it is either managed by people who are part-time wealth managers like bankers, or where the client is themselves trying to figure out where to deploy this capital. So it's still a very early time in our industry and a long, long way to go.
Yeah, so there's a nice tailwind that's coming along in terms of financialization of assets. What's happening on the SIP will obviously also have some impact on the larger pools of money which want now to go towards financial assets, not real estate and gold. Am I right in
Absolutely.
that?
Absolutely.
Think that trend will continue for the larger pools of money also?
Absolutely. And I think, and as we were talking just before we started recording, was the fact that India is a demand-supply mismatch country, right? I think the need for wealth management is much, much larger than the supply of high-quality wealth managers.
Sandeep, before I go into the mistakes part, I want to just have an overview of the advisory side. Right? You and Dezerv are one part of the overall advisory industry that's there. Now, when you started back in Kotak and then IFL, what you didn't mention, of course, was that Kotak and IFL built what I think is the largest wealth book in India.
Absolutely.
At least outside of the banks.
Yes.
Or maybe including the banks also. So obviously you know this for quite some time now. When you look at the advisory landscape for the wealth creators, by the way, okay, I'm not talking about people who are younger and manage their money on their own through SIPs, but here I am in your demographic. I have whatever corporates I have, 1 crore, 2 crores, 4 crores. What are the options available to me? Where do I go? Once I realize, okay, that boss, I need help.
Yeah.
Once I've exhausted that best performing mutual fund and trying my hands at all different things, now what's there for me?
Anupam, I would put this in broadly 4 categories, right? One is I go to my bank, which besides managing my banking requirements, my credit card, my mortgage, my forex payments, etc., also manages my portfolio. So that is one category of service providers. The second category of service providers are independent wealth managers, who I would say are people from my neighborhood whom I trust, my relatives, etc. Word of mouth, high degree of trust, but individual platforms or individuals who are doing all the work themselves and making recommendations. The third is focused wealth managers, which are companies somewhat like us and legacy companies which have been in the business of exclusively wealth management. And fourth is when people can't find any of these three, and that's a real problem, they go to a self-serve approach where they have to go per force and figure out for themselves, where they want to deploy money.
What are the areas where the first three don't service me as a client that makes me go to the fourth one? Sometimes maybe I start on the fourth one, but in my conversation with a lot of people, they do one, they do two, they do three, and they just say, I'm just disillusioned,
Yeah.
You think that, have you heard of that often?
It's very common. And I think the reason why that doesn't happen, Anupam, to my mind, is that as wealth managers, we are not able to build trust. I think clients and especially these wealth creators are smart enough to know that markets go up, markets go down. There are times when you and your wealth manager will make money, and there are times when you and your wealth manager will lose money, right? The issue that happens is that wealth managers are not able to generate trust or convince the client that they are on the right or the same side of the table as the client. And that is when a client is forced to go into the situation where they have to go and fend for themselves.
Yeah. I mean, it's not a comfortable feeling. You feel that you've made so much money, but you're not getting the right advice. Now, you told me about how the industry has certain, there's a trust deficit, let's call it for lack of a better phrase. Can you talk about investment behavior? Some of these people, when I speak with them, I just feel that they're obsessed with returns. They want the wealth manager to anticipate in advance what will happen on June 4th. Today, by the way, folks, we are literally recording on the day when the Nifty fell. What are the
5.5%.
5.5%, which you haven't seen for a long time. After yesterday rising by 3%. These are 48 hours in a fund manager's life that they don't want to see even once in 5 years. Anyway, so what is the investment behavior that needs to be changed from the client side? This obsession with I need returns, I need to beat the bench. Do you see that often, or because I see it often?
Okay, when people say fear and greed, it's not actually greed, it's actually FOMO, right? When you feel that, okay, I'm missing out on something.
I meet you at a party and I realize Sandeep's made more money than me.
Exactly. I think, envy is hyper local, right? So you only get envious of the people that you meet. So I think the real fact, however, is that people don't invest enough time in understanding how much money are they comfortable losing. Actually, everything about investments, all the decisions that I make are derived from this one data point. So if you tell me that, Sandeep, I'm comfortable if my portfolio goes down by 10%, even if it is for a short period of time, I will not lose sleep. Then I will construct a portfolio that optimizes or gives you the maximum return, keeping that in mind.
Yeah.
If you tell me, look, I can lose 25% and I will not get panicked, I will create a very different portfolio for you.
Obviously.
Right. A lot of wealth managers start this discussion the exact opposite. Sir or ma'am, how much return do you want to make? And that's an awkward question to answer, right? As a client, if you were asked that question, you will say, I want 100% return year on year, right?
Yeah.
But if the wealth manager is not asking you how much money are you comfortable losing, I think the relationship's starting off on the wrong foot.
Yeah. Now let's go into that question about common mistakes that the wealth creators make. So let me ask it in this way, that when a client finally signs on with you and you get their portfolio, you have a look at it, in the years that you've been around, what are the most common mistakes that you see? One you mentioned was best performing mutual fund, just chasing performance and landing up with some pretty vague decisions that harm your portfolio. Anything else?
Yeah, so this is one major issue, which is that looking at the performance of a fund manager, a PMS, an alternative fund, and assuming that will continue happening in the future. And that leads us to taking much more risk, because typically what has done well in the past is often things where that fund manager took disproportionate risk, or it was in the context of a certain environment which can't repeat today. So let's say if interest rates were low in 2020, 2021, the kind of fund managers who did well in that environment would be very different from the fund managers who do well in 22 and 23, right? So I think past performance bias, I think, is one thing. The second issue is that there is this need to invest in exotic alternatives, right?
Okay.
In the assumption that those deliver better returns than the core, conventional, and somewhat boring part of the portfolio.
Very interesting. Because I would have assumed that wealth creators are not even aware कि ऐसा कुछ होता है.
So, typically in bull markets, there's a lot of talk on F&O trading strategies that,
the guaranteed return kind of, 2% a month kind of
2% a month, somebody else made like double their money in X period of time, etc. There is sometimes a lot of inclination to invest in unlisted assets. In the 2021 era, the investments in startups boomed. So I think this sort of that the conventional is boring and does not yield returns.
That's one more.
So I think that is the second. And the third is sometimes I feel is this overemphasis on investments where you have a lot to do on a daily basis, right? The action bias, where you want to if an investment you invest in and forget about it is not as exciting as something where the trader or somebody will keep calling you and keep giving you updates. Okay, ab ye mature ho gaya, now isko yahan pe move kar do, etc.
I need excitement in life.
And that, because the assumption is action leads to outcomes, which is true in business, not true in investing.
Yeah. So days like today, which are very few, like we said, this is a great example that I find with a lot of people, that if I don't invest today, this is the opportunity for lifetime.
Yeah.
Nifty is down 5%. I have to put in money today.
Yeah.
What difference does it make over the long term? Does it? I don't know. I mean, that's one. It's probably FOMO or whatever, or excitement, whichever.
Or action bias.
Yeah. I mean, and those are flaws.
Yeah.
They were not going to lead you to any, unless you're someone who called this event long ago and bought like tons of puts and has managed to make tons of money, that's fine. But how do you talk to such people, who have that in them? How do you tell them that it's not going to help you, man?
See, honestly, there are three things that a wealth manager really needs to deliver, right? And it's a longer conversation, but essentially transparency, investment process, and engagement. I would put this under the category of engagement. As a wealth manager, it is my job at such points of time to be actively in touch with the client, even if it means not doing anything, but just being in touch. Because what are you really paying me for? You're paying me for giving me clarity and reminding me of the eternal truths of investing on days like these, right? And actually that role of the wealth manager is underestimated oftentimes, because if I can keep the client and their portfolio on the right path by being actively in touch with you during these kind of things, I'm actually saving maybe lakhs and in the future crores worth of opportunity cost of making the wrong choice.
And if I tell you one thing, it's this, that whenever I speak to people who ask me about this whole wealth management thing, I tell them, and this is a lost message because I have given up. I say that this is about a relationship. Please look upon your wealth manager as a relationship, not as an avenue to make double your money or triple your money and all that. But they listen to it. I don't know what they do with that. I mean, I don't know what's been your experience. That's the message I give to them. I say, find a person who you can stay with over the long term. What's the deal with 18% a year, 25% a year, 2% a month? What's that going to do? But I don't know whether that message is there with them. Now that we are done with all the discussion on the industry, behavior, this, that, blah, blah, let's talk about the products that you guys have. Like, let's say someone from our audience is ready to jump in, or what's the stuff that you offer?
So we have a very different worldview on wealth management, Anupam, which is that a wealth manager is not a supermarket, right? It's not required of me to have everything in the universe available for you to invest. I would rather only have those things which are actually right for the portfolio. So typically what we do, and I'll answer the question on products, essentially we first start with a audit or a review of the current portfolio, because that one tells me which are the areas in the portfolio that actually need intervention, and a large part of the portfolio might actually be fine, and therefore I should not force fit anything there. And secondly, it also helps me understand how you are thinking about investments, because it's one thing between what's said and what's actually happening in the portfolio. In what's actually happening in the portfolio, I might see that during volatile moments, there are clients who've redeemed from the portfolio. That informs my ability to create portfolios for you. So that is one part. The second thing is we break up our asset pools into three buckets. One is steady return, which is sort of money to sleep well at night, and that is typically oriented towards fixed income of various types. Now, if you have shorter tenures, it will be bonds. It will be longer tenures, be slightly higher yielding instruments. The second is the growth bucket, which is typically invested in Indian equities of some sort. We are big believers in investing via direct plans of mutual funds, mainly because we feel that mutual funds have a tremendous tax advantage, and their scale gives them the advantage to invest in technology and team in a way that, let's say, individual investors can't, right? And the third category is very, very selectively what we call growth plus assets, which is every once in a while when there's a deep conviction on an asset which is today unlisted, then we activate that. But that's a very small part of the portfolio. I think the bulk of the money is in steady return and growth assets. The growth assets are more because in India, inherently, there is a belief that over long periods of time, and it's not misplaced, that equity assets will deliver higher yields. And sleep well money goes into steady return portfolios.
You talked to us about the PMS AIF part for a bit. I mean, we spoke about the mutual fund side. You said something about PMS and AIF also.
Yeah. So essentially, the PMS or AIF or even RIA is a way for a wealth manager or an investment manager to engage with you. These are regulatory licenses. Now, what is the fundamental difference between PMS, AIF on one side and RIA on the other? In an RIA, the advisor will make recommendation to you and you will decide whether you want to accept that recommendation or not. And PMS on AIF largely are assets where you are giving the mandate to the investment manager and on a day-to-day basis they are managing. So we use the PMS AIF as the regulatory licenses to be able to execute on steady return and growth portfolios. Now on the growth side, like I said, we prefer direct plans of mutual funds. So a majority of our assets on the growth side are invested in direct plans of mutual funds via a PMS that we run, right? And that PMS is called the Equity Revival Strategy, which essentially focuses on two outcomes. One is I need to deliver outperformance to benchmark. And the second, which is an equally important outcome, is I should lose less money for you when markets are down, which is an outcome which we call down capture. Right? My down capture should be less than 100. So that's how we manage that money. On the fixed income side, we do it via bonds and to some extent InvITs and REITs, which we buy via the PMS structure.
So how boring, yaar. I come to you with my money and you say you're going to put in mutual funds. ऐसे कैसे आप कर रहे हो यार? I thought you'll give me some nice sexy stocks and this and that. How are you putting in mutual funds only? I'm just joking, but
no, I
don't find this.
That's a question that we get from a lot of clients actually.
I told you
that यार ये तो बहुत ही simple है. And over time we actually, the only way to answer these questions is using data, right? When you show data of actively managed, say, direct equity strategies versus mutual funds, much more, very high degree of probability that the mutual fund portfolio is actually outperformed. And like I was referring earlier, mutual funds provide a degree of tax advantages which actually we underestimate.
Yeah, of course.
Right. So every time there's a fund manager buys and sells stocks, I don't pay tax. Every time the stocks in the portfolio receive a dividend, I don't pay tax. The fees that I pay to the fund manager are adjusted in the returns. So therefore I pay tax on only net of fees returns.
Yeah.
Which product gives this kind of... and there is so much concern around this, that how mutual funds are advantageous, that bankers are worried about it. Bankers are asking governments to correct this anomaly, right?
Oh yeah. We saw how that played out on the debt side. Okay. Are there any asset classes that you provide, that are exclusive? Like, do you do unlisted? Do you do anything of that sort out there?
We do offer unlisted options, but like I said, Anupam, it has to be deeply researched, and it has to be very limited in the context of your portfolio, right? So only when the portfolio is large enough, we think it should be offered to clients.
Cool.
So let's say an unlisted asset, for it to be in a very small portfolio, is not appropriate for the risk that the portfolio can take.
Yeah.
And that's something we keep in mind.
What are the costs involved out here? How do you guys make your revenue? For me, what do I have to sign up for? What would be my expenses? Out goes to you. How does that work?
So Anupam, when we started the portfolio management business, we had a very unique approach to it. We said that we should make money only if we deliver returns. So our PMS strategies operate on zero fixed fee and only a share of profit. We believe that's the best way that we can align ourselves to clients. So that's essentially the large part of our revenue model.
So if I understood that right, you're going to put my money in a mutual fund portfolio in the direct scheme. So
Yeah.
obviously, I'm not going to be paying anything on the distribution cost there at a fund level. But what that means is that at the end of the year, once I'm actually getting outperformance thanks to the recommendation that you've made, I have to pay a portion of that to you.
Yes.
You find people paying that, or they just run away somewhere or something?
No, actually, no. In India, what actually happens is this aligns with the value system of a lot of Indians. That so long as I'm paying out of the returns, it's actually okay. Actually, and this something that we have realized across businesses, not only in wealth management, that India is not a market where people don't want to pay.
It's counterintuitive, no?
Yeah.
Yeah, I know.
People are okay paying provided they get value. So value consciousness is actually higher.
Very interesting.
Right? And if you recognize that, I think people are actually quite happy to engage that way.
So this is very different from the wealth manager's model, right? Which is AUM based.
Yes.
You just go on collecting and collecting and collecting, and you get whatever 1% of that.
Yeah.
You think that aligns incentives better for you, for the client, because
it does actually, and it's a conscious business choice because in some sense we are also taking market volatility, right? We have to absorb that as a business. But it's one of those things where you say that as an entrepreneur, you will make this work. And therefore, whatever it takes to do it. Only later we actually realize that this is not as bad business for us as it seems from the outside in, because clients come in at different points of time. Even clients are putting in money at different days. So in a sense, there is dollar cost averaging happening on the overall portfolio.
So then your fees are it's like a typical PMS fees. You'll have performance based fees.
But we don't have any fixed fee.
You don't have any fixed fee. Yeah. High watermark, low watermark, stuff like that. Or
so high watermark is a part of the regulation. So any performance-based fee in India has to go through a concept of high watermark, which means that on the same profit, I can't charge fees twice.
Yeah.
That's the principle.
And of course, folks, you want to know more, please reach out to the good folks at Dezerv. They've got a pretty proactive team who can walk you through the products that they have. Okay, last and final question. Sandeep, give us a checklist on how to choose a good wealth manager. I mean, let's try and, get all the wisdom that you've spoken about on this episode and into a nice 1, 2, 3, 4, 5 checklist for our audience. Okay, now that I know what a wealth manager is, I'm going to go out and I'm going to look for one, and I'm not going to start from best performing mutual fund.
Yeah.
Okay.
So there are many, but as in any good things, there are 3 things that are most important. First, to my mind, is transparency. Right? Does the wealth manager be very clear with you on how they are making money, right? And it's important here to recognize that there is no free lunch. So if a wealth manager says that I am doing it for free or this is no cost, etc., you should run as far away from that as possible, because everyone has got a business to run, and they need to be profitable for you to get the best, right? The second is the I. So T for transparency, I for investment process. Every wealth manager should put out to you what their investment process is. How are they selecting instruments? Is it a group of really smart people who are doing that? Or is it a algorithmic model? Or is it some research? What that is should be very, very clear to you. And third is E, which is engagement, which is how the wealth manager reaches out to you during good times, bad times. How do they advise you? Are they willing to pick up your phone whenever, like that 12 midnight call, if you're panicking about your portfolio? I think those are the 3 things to me that are most important.
And how do you guys do the E part? Do you have a dedicated RM that you give to your clients? Is it?
Yes. So there is a very active RM team, both when you're onboarding and thereafter when you become a client also. So you have 2 ports of call. And the third is we have a very active customer support team, which is also available to you.
Okay.
So, and I actually think that the job of wealth managers is to be available at your beck and call when you need it. Because even when you're calling me in the middle of the night or on a weekend, that it's something that's bothering you. And I need to answer that question at that time.
Yeah, and what better time for me to ask you, now that I have you here on this episode, now that I've had a day in the market like this, at the risk of sounding very, very, TV channel types, kya lagta hai? I mean, okay, let me not say kya lagta hai, but where do we go from here now? I mean, what are you telling your clients? What's the kind of advice you would have given at the end of a day like today, where you've had the Nifty down 6%, stocks have had massive serious corrections? What's the conversation that you're having? What's the advice that you're giving?
So it's very topical, depends on when this releases. So I might be wrong, but I'll tell you what.
I think our standard thing is about 4 weeks on, but hopefully 4 weeks में कुछ बदलना नहीं चाहिए. हो गया तो मुझे पता नहीं, but wait, that's a disclaimer, ना, folks. That this 4th June 4:50 के लिए ये advice valid है. Okay, when it airs, I don't know, but man, I don't do episodes like this. Go on,
but
Sandeep,
look,
go on.
I think it's about back to basics. In a way, a big event is over, right? And everything in markets is about, especially equity markets, is about flows and fundamentals, right? If you think about fundamentals, we are broadly in a good space. Economic growth is there. Yes, there are problems in the agrarian sector. There is problems in the consumption side, but the capex and the investment government infra is quite high. So I think that is the fundamental side is fine. On the flows side, we are fortunate. Domestic flows are very, very strong into markets. SIPs, we just spoke, nearly $3 billion a month is coming in from there. FPI ownership in India is probably at its lowest in the last 4 or 5 years. So I think we can only move up from here. So if fundamentals are decent and flows are likely to be positive, we will be okay, right? And I'll answer what okay means to me. And I think therefore, in a sense, after this election result, it's back to basics, right? A big event is over. Essentially, unless I'm horribly wrong, the same government in some shape and form will return. So we need to focus on what the reality is. Then the reality is that India is growing at a GDP of between 7 to 8%. Last quarter was 8%, but let's say 7%. Inflation is 5%. So that's 12% of nominal growth. 2 to 3% companies will do better, so 14 to 15%. So our market should compound over the long period of time at 14 to 15%, which means 100 rupees today can be worth 200 rupees in 5 years. You just need to ride it out. Have a good wealth manager who explains this repeatedly to you, and you'll be okay.
Thoda specific do na, please. Okay. Let me put it this way. And it's a question that I get asked a lot. I'm sure that you also get asked a lot. What's the right way to pick a mutual fund?
Okay, so what is not the right way of picking a mutual fund is to look at the past performance. What is the right way? So broadly, there are certain macro parameters in the economy like interest rate, GDP growth rate, etc., which determine which style of investing is likely to do well in the current environment. And then there are micro fund specific parameters which determine within a style which fund manager or specific fund is likely to do better, right? So fund size. So let's say if it's a small cap fund, what is the size of the fund relative to the market cap opportunity the fund is going after? What is the concentration in the portfolio? What is the sales growth of the underlying portfolio? What is the PE, PB of the underlying portfolio? So these are micro parameters specific to the fund.
Okay.
So what I would do is to recommend to investors that first get the macro right. Think about in the current environment, which is the right style I should invest in. And by style, I mean things like growth, value, dividend yield, contra, small cap, mid cap, etc.
Read the fund management document, understand the fund manager's philosophy.
And after that, try and figure out which is the right fund within that style to pick.
I mean, there's no right answer for probably every audience that we're looking for some people who are on a different risk return point. That fund might not be relevant for others.
Yeah, but I'll tell you specifically, Anupam, like today, and this is again June, unless there's a big dislocation in the market, we are overweight on large caps. So 70% of our allocations are directly, indirectly via mutual funds to large caps, and under 30% is allocated to small and mid caps.
Okay.
This number, if I go back approximately a year, would be close to 50-55% would be large caps and 45-50% would be small and mid caps. So over time, essentially, we've pulled back on the risk and increased the safer part of the portfolio.
Yeah. What on the debt side? I thought the debt side would be more exciting, right? Because I don't know whether it happens this year, maybe it happens next year, but when interest rate starts coming down, what's your view there?
I think there is a good opportunity on the debt side also. See, today, decent quality bonds are yielding around 10 odd % return, right? And in bonds, everyone often makes the mistake of relying only on credit ratings to select bonds, whereas actually performance of the company, quality of the company, ratings one part, and solvency of the company are other factors that we need to consider. Keeping that in mind, to get 10% is today viable. And I would definitely allocate. So if I had fixed income money and I'm willing to sort of put it aside for the next year and a half, 2 years, I think this is a great time to do that.
Very interesting. Okay, that's it. We are done. Our last standard question that we ask all our guests: anything that you're reading, book, or anything that you're watching, anything that you'd like to share with our.
So it is very interesting, given that today is election results day. I just finished this book by Neerja Chaudhary.
How Prime Ministers.
Prime Ministers decide. And it was very fascinating, because as a young kid growing up in that era, I didn't know all of this was happening behind the scenes.
It's a wonderful book.
It's a beautiful book. And
very inside views, insider takes of how the thinking happened from Indira Gandhi to a lot of
to VP Singh and Atal Bihari Vajpayee, etc. They've obviously not covered Modi because she said she will not cover a sitting prime minister.
Right.
But I think it's very interesting in how people in positions of power, and especially this kind of power, take or make moves, right? And I think it's very interesting. There's a very interesting part within that about how Manmohan Singh took on the US-India nuclear deal. And that part I keep going back to because he had to stand his ground and execute on it.
So much to learn from, huh?
A lots to learn from.
Folks, the book is How Prime Ministers Decide by Neerja Chaudhary. That's the recommendation from this episode. And that is a wrap on this episode of PaisaVaisa. My guest, Sandeep Jethwani, co-founder, Dezerv, Dezerv.in. Sandeep, thank you so much for doing this for listeners. Come back, hopefully after some time when markets have settled down, and let's see how things are.
Yeah, hopefully we'll all be fine.
I'm sure we will. Thanks, Sandeep. Thank you so much.
Thank you so much, Anupam.
IVM